Good afternoon. Hope the day is going well. I think, at least the rumor is, it's better to go after lunch as opposed to before lunch. Hopefully the crowd is a little friendlier. I do want to thank Judy, who actually is a superb board member. I'm a big fan of UCLA. I'm grateful to be asked to speak here, despite not attending the fine university. I'm a big fan of many of its professors and administrators. Bill Ochi and I sit on the board and have, I think, for longer than we want to admit on the Alliance, and it's been an extraordinary board, actually, and mostly because of folks like Bill. I guess I'm not exactly sure what everyone wants to talk about. It's obviously an investing conference, so we have to touch on that a little bit. But from what I understand, you've heard a little bit already, if you will, about the world of alternatives and credit in the morning sessions. And hopefully we'll have a little bit of a different approach from what you've heard. Of course, I didn't hear it, so we'll find out. But my intent is to talk about alternatives, whatever that really means, by the way, and also talk a bit about Ares Management, which is a firm that I help run and have built over the past 15 years. If either of those subjects are offensive to you, I would recommend you leave now. But I'd rather you stay. Yeah. My view on alternatives, my view on the world we live in, it's pretty straightforward. Alternatives were created, as most of you I hope would agree, as an alternative to global equities and traditional fixed income products. And generally speaking, to me, that's part of the opportunity, part of the problem. It's also why alternatives are described by so many people in so many different ways. Regardless, I'm going to try to use the next few slides to highlight why, regardless of what all of us in this room might think or might want, hopefully the next few slides, I would argue, will evidence to you or help evidence to you why alternatives are going to be a larger part of global assets. They have grown and will continue to grow over the next several years, and will grow at a faster pace than traditional assets. I'm not so sure we're going to talk about whether that's good or bad, at least in the first part of the presentation, but I do believe it's going to happen, and we should think about it, figure out how we want to benefit from it, or at least not get hurt by it. So we tried to come up with a few slides, and I think this is the one obvious slide that doesn't jump at you, but simply it's 10-year treasuries. Interest rates have gone down. Shocking statement, I'm sure, to everyone here. But over the past 10 years, if we have a 10-year treasury of, I don't know, 1.8 today or something along those lines, and it was 4 or 5% 10 years ago, interest rates have gone down. So much credit product is, of course, tied to interest rates, whether LIBOR, whether the 1, 3, 5, 7, 10-year treasury. But the point is, interest rates are going down, have continued to go down, and therefore it makes people more nervous about generating yield. Clearly, in my argument, a contributing factor as to why alternatives have grown. I think if we go to the next slide, at least there's more pictures, but another contributing factor, again, and if any of this, please, hands up if you guys think this is wrong direction, you disagree, but generally speaking, increased volatility, if you will, is another, to me at least, obvious contributing factor to why alternatives have and will continue to grow. And it may not be actual volatility or just perceived volatility. And whether it's what's going on in the Ukraine and Russia, whether it's what's going on in the Middle East, whether it's what's going on in Africa, or obviously what's going on when oil goes from 100 to 50, increased volatility makes global equity markets and the marketplace overall far more volatile. It makes long-term investors more uncertain, more nervous. They look for things, if possible, to generate more yield. albeit, than what they might get in certain markets and certain asset classes, but with less volatility, if that's possible. So my argument is increased volatility has absolutely contributed to the increase in alternative assets. This, again, under exciting pictures, this is simply pension funds and the difference or disparity between liabilities and assets in the nation's public pension funds. All that's saying, not trying to be highly political, but the liabilities that pension funds have to pay out to their retirees, to their constituents, are growing faster than their assets or their return on assets and their overall assets. So that disparity has widened, as this slide would indicate, which is sad in certain ways and obvious in others. But what it highlights is that if you're managing a large pool of capital for a pension fund, as you see that disparity widen, your board, your boss, your friend, who might at some point in the future become your enemy, is forcing you to take more risk, to generate more return, first and foremost, which of course leads to you taking more risk. And whether or not that's a good thing at the time in the marketplace we find ourselves, we could deal with that a little later. But please understand, the rise in pension liabilities absolutely is leading to the increase in alternatives and the, if you will, search for yield. At least that would be part of my argument. The next slide, which is not here, is actually on bank regulation. And I'm arguing that pension liabilities growing is one contributing factor, and one additional, actually the last of my 4 contributing factors, is the massive increase in bank regulation since 2008. And what that slide would tell you, which by the way is also incredibly boring and irrelevant for you to have to read, but I think that another factor we can all agree on is that governments around the world post-2008 are insisting that banks deleverage, simplify their balance sheet, increase the transparency on their balance sheet, and generally get out of certain assets that, at least I would argue, appear to the regulator and to the general marketplace, not always the case, but appear to be more risky, more dangerous. And in many instances, I actually think the regulators are 100% right. Some maybe not so. But the bigger point is that banks, large financial institutions, must simplify their business. And because they must exit aggressive real estate lending, aggressive corporate lending, structured credit, hedge fund management, private equity, many asset classes that have to go somewhere else. And the world of alternatives, and I assure you, because our firm is one of them, many firms focused on alternative asset management are going where the banks are leaving. And that has been exacerbated, if you will, by bank regulators and the absolute mandatory requirement of most governments to see their banks better capitalized, more simply overseen. Whether this will work, but it is fair to say that aggressive investments and aggressive lending actually should not take place in a financial institution that's 12 or 14 times levered, that has access to a Fed window and government insurance for its depositors. So if you want government support, you want access, what do you know? But I think we've dealt with this factor of simplifying bank balance sheets, reducing leverage of financial institutions, may not be as obvious to the growth in the alternative asset class, but at least from my perspective, as important as the low interest rate environment, as global volatility, as increased pension liabilities. So the argument I'm trying to make which, again, everyone has their own perspective on the investing world. In this world of alternatives, there are 4 meaningful factors that have all, if you will, contributed to the alternatives growing faster than assets overall over the past 5 or 10 years, and I would argue for the next 5 or 10 years. And the next 2 slides, if you will, is more evidence of just that, of what percentage of global assets will be invested in alternatives. And whether you believe these numbers or even more aggressive numbers, as some have, I think McKinsey did a study, and for what it's worth, as you see, this is global assets. Unless I'm missing something, we believe at least, there's very little that can happen that will change the direction of the growth in global alternatives. You might slow it down with certain things, you might speed it up with certain things, but generally speaking, the thesis is that global alternatives will grow faster than assets overall and become a larger percentage of the asset management pie. So if you go, generally speaking, what we then do, and I guess my last point on alternatives, or I should say on the alternatives, on the industry and its expected growth, is it's not at all exclusive to institutional investors. And we could probably talk a little bit when you see about this. If you can't see it, I apologize, but on the left-hand side is just the number of U.S. alternative mutual fund and ETF portfolios, and then the AUM of alternatives. So what I'm trying to point out is it's not just in the institutional portfolio, but maybe as aggressively in its growth in the retail portfolio. I guess there is an obvious question on whether this growth in alternatives is in fact a good thing or a bad thing for the investor. I think my answer is simply not, it's just not that simple for a relatively simple and straightforward question. It's too general a question, frankly, because there are many, many alternatives and alternative asset managers and alternative asset classes that simply charge too much money and generate too little return, and have over a course of an extended marketplace. On the other hand, which is where it becomes both embarrassing and rewarding, listen, I've spent the last 15 years trying to build an alternative asset manager, so I'm biased. I obviously believe that alternative assets are real, do serve a purpose in the portfolio, will continue to serve a purpose, and helps large investors diversify. I would also argue, and this maybe isn't as obvious, it is to us after what we've been doing the past 15 years, but we spend our day, and I think I could speak for many alternative asset managers. You run into 2 types of large investors in the world, generally who run really large pools of capital. And if they're fixed income oriented, they're generally investors and knowledgeable, as I'm sure many folks here are. But in the traditional fixed income space, their expertise is in treasuries or agency mortgages or corporate high grade, maybe emerging markets, but they're fixed income managers, and they are unbelievably nervous about the low rates of return either they expect or their consultants expect in today's marketplace. So earning 2, 3, or 4% in a traditional high-grade bond portfolio when your boss expects a 7 or 8% payout to your constituents or beneficiaries, again, makes the traditional fixed income investor incredibly nervous. The other type of manager is generally the global equity manager, US, global, whatnot, a large public equity expert, incredibly successful in 2014 if they focused on US stocks, particularly S&P 500 stocks. But generally speaking, the public equity folks or their board or their boss is increasingly nervous about the global volatility and the, shall we say, inconsistent returns in the portfolio despite a spectacular 2014. And how long can it last? And can I put my entire portfolio in global equities or US equities with that amount of volatility that I'm exposed to? So you have two different types of nervousness. And what we've tried to do, now getting to the self-serving part of the presentation, but what we've tried to do is build a business over the past 15 years that actually could solve either of those problems. Attack the fixed income investor with an alternative suite of credit products that we argue can make more return without excessively more risk. And of course, private equity products that we think could meet or exceed the global equity returns with far less volatility. And that's literally the background on how we started the firm and why we continue to believe the firm has a decent future. So on page, well, I should say just this next, I guess it's slide 10 that I'm not sure if anyone here can see, but what we tried to do is highlight, of course, risk and reward, and at the bottom, and this literally is what we give every investor and every potential investor, and what we think, at least, we tried to do over the past 15 years at Ares Management, which is above, and generally if you see 5 to 10, maybe 5 to 12% returns, if you will, all of which are trying, correctly described as credit strategies, generally are all fixed or floating rate, fixed income-like securities. Whether we're raising capital, whether we're investing, we offer 6 or 7 credit products trying to generate 6 to 12% rates of return. And of course, trying to compete in a 2 to 4% high-grade bond world. And yes, we are often less liquid. Yes, we utilize leverage on some of our products, particularly the first lien or first mortgage lending products. And yes, we charge more fees. The argument, of course, and the entire bet that we're asking people to make with their pools of capital is, can we generate meaningfully higher returns, literally 2 times the Barclay high grade index, if you will, but 2 times the traditional fixed income investor without 2 times the risk. That's the pitch. And generally speaking, we've been arguing this very pitch for a very long time. And again, whether we utilize leverage, whether we increase or insist on more lockup, yes, self-originated credit products versus tradable credit products is a whole nother debate, all of which are included in the world of alternatives. But what we're trying to say is the top 6 or 7 boxes each represent products with large groups of investment professionals, and each go to market trying to explain, sometimes, by the way, as an alternative to private equity or equity investments, sometimes as an alternative to the traditional fixed income investor. But we're basically arguing we can earn 6 to 12% returns in today's world without the level of risk one would assume for 2 times the return. And frankly, all of the equity-like, or for us, all private equity products, even if we include the distressed or special situations funds we manage, but whether it's real estate, whether it's traditional buyouts, private equity-like products, whether it's distressed, we have a small business in China doing growth capital. But generally, all of those products, we're arguing, yes, we're looking for 20+% returns. Yes, we want lockups, 5, 10+ years of lockup. So please appreciate the level of illiquidity in the product. But for that, we think we could demonstrate or evidence to you that we're making good returns, i.e. better than your public equity marketplace with far less volatility. And that's the argument we have to make, and obviously we have to evidence with real returns. So literally the entire premise of Ares Management, of the firm that we've been building the past 15 years, has been, we think we can be a legitimate alternative to traditional money management. And actually, the goal is not to criticize traditional money management, highly liquid fixed income or equity portfolios, or other alternative asset managers. We're just saying if we could solve for those two major problems that many investors have. I'm nervous about volatility in my equity portfolio, and I'm very nervous about 2% returns in today's interest rate environment. If we could solve for those problems, our assets will grow nicely. And I think generally speaking, that's been the case. So the next slide is really how we describe the firm. It's simply an overview of the firm. We do manage at Ares about $84 billion in assets, and we run it in 4 distinct businesses. And from left to right, we run about $33 billion in tradable credit. So everything in tradable credit, just as it sounds, we're buying off trading floors, but we're trying to be more diverse and certainly more aggressive in the types of securities in terms of rating. So it's generally below investment grade debt securities. And we define that as syndicated loans, high yield bonds, distressed debt securities, CCC, post-reorg equities, and then structured credit. But generally, that's intended to be, if you will, highly diverse, not just in the number of positions in a portfolio, but in the ability to move from asset class like loans, floating rate, senior secured, to asset classes like high yield bonds or structured credit or distressed. Fixed rate, maybe far less liquid, maybe far higher return. But again, in different markets, we find moving those portfolios around help the investor ultimately. So certainly tradable credit, approximately $33 billion. Direct lending, that $28 billion. Again, to the earlier point of firms like Ares, many others I would argue, are trying to go where the banks are leaving. Whether that's a temporary phenomenon or a permanent one, we can debate. But there's no doubt that large financial institutions, based on the regulatory environment, are lending less, and certainly less aggressively, to smaller and medium-sized companies. We make the argument that lending to smaller and medium-sized companies is a very attractive asset class. We lend to hold the loan as opposed to lend to syndicate the loan. We do it in public structures, we do it in private structures, but the point being, we're lending to smaller and medium-sized companies, and the bet we have made over the past 20 years in this asset class is that the smaller, medium-sized lender is actually a faster grower, but as good a risk as some of the much larger borrowers we see in the marketplace. And we think we could evidence that, and more importantly, we're not saying we lend at the same yield or at the same spread, but round numbers, the smaller company is forced to pay a LIBOR plus 700 as an example, where much larger companies might borrow at LIBOR plus 4. Those 300 basis points is a lot of additional yield, and of course the question is there a lot of additional risk for the smaller company? We argue no, and we think we could evidence that over default rates and recovery rates to smaller and medium-sized companies. They're also the largest creators of jobs in this country, I might add in Europe as well, over the past 20 years by a substantial margin. So direct lending is a very real business, one that is growing fairly dramatically as banks are forced to improve their balance sheets and deleverage and focus, frankly, on the large corporation and the individual. Private equity is exactly as you would think it to be. It's about $14 billion, and we do buy companies. We do have some high-quality companies and businesses. The job is to own them and to grow them. We do own a Neiman Marcus. We do own a 99 Cent Stores. We do own a Smart & Final. Again, the focus is buying businesses to make bigger and better. That is a clear alternative to global equities. And we would argue, and granted, because there's no public mark, some would argue it's simply buying public stocks with leverage. We argue it's actually buying companies with much better information utilizing leverage, and therefore you should outperform the public equity markets. And I think we could show that we have. The last pool or business that we run is real estate. Like the corporate businesses, we run that as both lender and as owner of properties, i.e. seeing the flow from developers and owners of real estate to improve your lending is of huge value, just like seeing, if you will, the flow of tradable credit or direct lending to benefit our private equity business. We're probably analyzing 1,500 companies a week in our corporate businesses and something in the neighborhood of 300 properties a week in our real estate business. Again, between lending and purchasing. Again, a huge benefit for debt and equity to complement one another in their flow, in their access, in their relationships, in their fundraising, and in their ultimate investment decisions. So again, this is how we describe the business. And I guess the last slide, this is, I guess, the commercial, but let's face it, you live or die with your performance, and we are proud of our performance. But we've argued over the past 15 years that, generally speaking, assets follow performance. And we have grown from about $2 billion in 2001, I guess January 2002 when we spun out as an independent business. And we've grown to $84 billion over the past 12 or 13 years. A lot of that, as you might imagine, is good luck, which we accept, by the way. A lot of that is an up market. But a lot of it is kind of sticking to what you know best and not going after things that you hope to learn on the fly. So for us, that's been an attractive run. I think we have learned that some of the best investments are those that you don't do. And some of the most exciting times are when you choose to do nothing. But all that being said, and maybe much more important to us, at least than our performance or our size, we do think we serve a purpose. We do help retirees plan for the future. We do help allocate capital to better companies and real estate developers. And we are proud to be in the asset management industry. This is an exciting world of alternatives. I guess that is the end of the formal presentation. That's how we've built the business. It's how we've convinced ourselves that alternatives will continue to grow. And thanks very much for your time. Appreciate it.